Hello, Hamish here from mortgagesonline.co.nz. Low deposit borrowers could see some changes, debt to income ratios could be coming in, and actual interest rate floors. So what does it all mean? I'm going to get right into that right now. So first of all, low deposit borrowers. So usually, these are really first home buyers, right, is what we're probably talking about. But if you have less than a 20% deposit, and not all of them are first home buyers, to be fair, but that's a thing actually. You can actually buy with less than 20% deposit, even if it isn't your first home with most banks. Now, this is changing. At the moment, 2 out of 10 people, or 2 out of 10 loans can be under this, roughly speaking. So actual rules are worded slightly differently, but as of October, this number is going to drop to half. So 1 out of 10. 10% of the loans will be able to be less than 20%. Now, there are some exemptions to this. New builds, of course, Kiwi also under the welcome first home loan, I should say, under Kāinga Ora. Although the amounts are restricted somewhat under that. So what will we see when this happens? Now, interestingly, the actual retail banks are already running under 1 out of 10 overall. Back in 2013, when these macroprudential rules were new, we actually started with the 1 out of 10 rule. And the banks kept it well under that back then as well. So look, what you may see is that it's just, in terms of actual practicality, the rules tighten up. So 30-day pre-approvals maybe instead of 2-month ones, and you might also see things like banks from time to time will only look at live deals, so maybe they will help their existing clients first, which are usually people that have been depositing their income into that bank for a few months. So these are all changes around this space. Now, debt to income ratio, what does that mean? So basically, most countries that run these debt to income ratios basically say that, look, 5 to 6 times your gross income should be the max amount of loan. So if you're earning 100k, you might find that the bank says you can't borrow more than 600 grand, right? That's in other countries. In New Zealand, what I've seen lately, I see a lot running at 7 times the income. So look, 6 times is not going to be the end of the world, but it will have an impact. Interest rate floors, okay? Now, first of all though, going back to debt to income ratio, this will take quite a few months to put in place because obviously each bank has their own system and their way of working things out. This overlay, how it's going to work and everything is going to go through some consultation and stuff, maybe up to 6 months to put this kind of thing in place. What might be faster is interest rate floors. So what does that mean? Most banks, basically, they aren't using 2 or 3% to calculate how much you can afford, right? When they look at your situation, in the background, they're actually going, hey, could this guy or this girl afford it at 6 to 7% interest rate, right? That's what they're kind of doing. So the Reserve Bank is saying that this might be formalized somewhat, and the Reserve Bank may have more control over this, and this number could obviously, they could say, hey, look, could they all afford it at 8%? The idea of all of this, remember, is not to actually drop house prices, okay, because that's not in the mandate for the Reserve Bank. What this is probably, what it's designed to do is prevent any shocks to the system. So basically what they would like is that if there is a sudden price decrease, that people can afford to hang on, and that ideally there isn't a big up and down, right? So that's kind of what the idea is, just to kind of go slow and steady. One of the other things that comes off the back of this is that having these other tools means that there's less pressure on the Reserve Bank having to put the interest rate up to control things, right? So it's actually, some of this stuff is actually a good thing, plus it kind of inbuilds an insurance policy for future shocks. So like we saw in COVID, hey, we looked like we were in real trouble. The Reserve Bank could drop interest rates, but they also actually released some of these insurance policies, I say, but some of these things to make it easier for borrowers to get back in and keep the economy going, I guess, as well, because that actually does help when things are tight or the forecast or confidence is low. And let's face it, in a way, through COVID, maybe it has actually worked somewhat. Thank you for listening. Hopefully that has been insightful.